A Dividend Aristocrat is a company, and you can Google Dividend Aristocrats to get a list. A Dividend Aristocrat is a company that has not only paid a dividend for at least 20 years in a row, but has also increased that dividend for at least 20 years in a row. Probably the classic Dividend Aristocrat, I'm going to go back to Buffett here, is Coca-Cola. Buffett is the largest shareholder in Coca-Cola. And I don't have these numbers exact, but you can go on and read his letter and you'll get the numbers exact. I think this was in the 2010 letter. He talked about this. Buffett buys stocks on a regular basis until he reaches a level that he feels that's as much of this I want to own. And he's basically something along this lines. He said, over the years, we've invested about $600 million in Coca-Cola stock. And that means going way back, buying it really, really pretty cheap in some early years. Every year that we've owned it, he says, they've raised the dividend. And that means every year we get more income from this company. He said, we've owned this company for 25, 30 years. He said, by the year 2015, every year we will receive a dividend equal to the amount we invested in the company. He will get paid $600 million a year in dividends. That's a 100% return on your money every year. And you know what? The year after 2015, it'll be more and more and more and more every year that goes by. That's the real key of investing, is to get those dividends, take advantage of what Albert Einstein called the eighth wonder of the world, compounding, and let it just work for you. Let that money work for you. You know, none of us in this room, I believe, will ever save $1 million. You'll never save $1 million, but you can invest money today, and that money has the potential to grow into $1 million. Okay? You'll never become a millionaire trying to save money. I'm not saying you shouldn't save, but the way you become a millionaire is to have your money grow. And that's what Buffett and many others have talked about for years. So I think that's a classic example. Everybody knows Procter & Gamble. How about this company, Sunoco? Anybody know Sunoco? Gas company, right. It's a gas company. What did they do here? Oh, come on, George. It's right here somewhere. Oh, yeah. Sunoco raised their dividend. Oh, by the way, Procter & Gamble raised their dividend 7%. Sunoco announced they're raising their dividend. It's not that big of a percentage increase, but this marks the 31st year in a row that Sunoco has raised their dividend. All right, let me go with the Procter & Gamble one. By the way, most of these companies, when they raise their dividend, it's usually somewhere around 10, 12, 15% a year, okay? So if you've got an investment and your income is going up 7% a year, that's pretty hard to beat, isn't it? I mean, just from an income perspective. Again, I'm not saying you should all rush out and do this, but I just think you need to kind of realize that this is the way to go. If anything scares me about dividends is that how much they are in vogue right now. I mean, you can't turn on CNBC or Bloomberg or Fox Business and not hear some guru talking about dividends as the way to go. And God love them, they finally caught on. But for a lot of people, dividend investing has been a very smart and common way to go over the years. So it's a real practical, easy to understand process, and you should explore this. By the way, there are about 52 Dividend Aristocrats. You can buy them individually, and you don't have to buy all 52. If you did want to buy 52, all of them, there's a couple of exchange-traded mutual funds that are index funds that clone the Dividend Aristocrats. One is trades under the symbol of SDY, Sam David Yellow. And the other one is, bless you, DVY, David Victor Yellow. And those are both index funds. When I say index funds, the first thought you should have in your mind is low fees, low fees. John Bogle, who is the father of indexing, said there are two things that sabotage your return as an investor, and neither of them have anything to do with the volatility in the stock market. The two things that will long-term erode your return as an investor are taxes and fees. And if you can control taxes and fees, you will be a successful long-term investor. So this is one of the great ways to do it is through index funds. And if you like dividends, those two are pretty good examples of ones you could take a look at. And if you don't want to use an exchange-traded mutual fund, go to any of the large family of mutual funds. There's one that starts with a V. There's another one that starts with an F, and you know the ones I'm talking about. Every family of mutual funds has a traditional fund that has the terms in one way or another. They appreciating dividend fund, escalating dividend fund, something like that. It readily identifies them as a mutual fund that buys companies that raise their dividend on a regular basis. So you don't have to use an ETF. Again, my preference would not to be, unless you were planning on buying, moving in and out of it and trading it, then it's a great vehicle for that. But I think most people don't want to go that way. So.